Good day everyone. Today we will going to discuss about capital budgeting decisions. The term capital budgeting decisions is used to describe how managers plan significant investment in projects that have long-term implications such as the purchase of new equipment or the introduction of new products for future returns, involving careful planning, cash flow analysis, and evaluating profitability over many years, distinct from daily operations. So, in this chapter, we will discuss the four methods for making capital budgeting decisions. The first one is the payback method. The second one is the net present value method. The third one is the internal rate of return method. And the last one is the simple rate of return method. So now, let's tackle to the capital budgeting and its overview. So the typical capital budgeting decisions, any decisions that involve a cash outlay now to obtain a future return is a capital budgeting decision. So the typical capital budgeting decisions include, the first one is reduction decision. This answers the question, should new equipment be purchased to reduce costs? So the company is trying to decide if spending money on new, more efficient equipment now will lead to enough savings in operating costs such as the labor, materials, or energy in the future to justify the initial investment. The second one is the expansion decision. This answers the question, should a new plant, warehouse, or other facility be acquired to increase capacity and sales? So the management is assessing whether investing in new facilities to increase production capacity and sales will generate enough additional revenue and profit over time to make the expansion worthwhile. The third one is the equipment selection decisions. This answers the question, which of several available machines should be purchased? So the equipment selection decisions involve choosing the best machine for several available options based on a comprehensive analysis of financial viability and practical sustainability. This decision-making process balances initial purchase cost with long-term operational efficiency and output quality. The fourth one is the list or buy decision. This answers the question, should a new equipment be leased or purchased? So this involves comparing the financial implications of renting or leasing equipment versus purchasing it outright. So the company analyzes which option is more cost-effective in long run, considering factors like cash flows, taxes, and ownership costs. The last one is the equipment replacement decision. This answers the question, should old equipment be replaced now or later? So this decision focuses on determining optional time to replace old equipment. It compares the cost of maintaining the old equipment and its potential salvage value against the purchase price and the operating benefits of the new equipment. The capital budgeting decisions fall into two broad categories. These are screening decisions and the preference decisions. Let's discuss first the screening decision. So, the screening decision relates to whether a proposed project is acceptable, whether it passes a present hurdle. For example, a company may have a policy of accepting projects only if they provide a return of at least 20% of the investment. The required rate of return is the minimum rate of return a project must yield to be acceptable. So the next one is the preference decisions. It relates to selecting from among several acceptable alternatives. So to illustrate this, a company may be considering several different machines to replace an existing machine on the assembly line. The choice of which machine to purchase is a preference decision. So let us now proceed to the cash flow versus the net operating income. Most budgeting methods, like the payback method, net present value, and internal rate of return, all focuses on analyzing the cash flows associated with capital investment projects, whereas the simple rate of return method focuses on incremental net operating income. To use cash flow methods, you need to know the main types of cash outflows, or the money spent, and the cash inflow, or the money received, that happen in a company's investment project. So the typical cash outflows, or the money spent, most projects have at least three types of cash outflows. So the first one is the initial investment. So these are the money paid upfront for equipment, installations, or other assets. If old equipment is sold, its salvage value reduces the cost. The second one is the working capital needs. Extra current assets needed to run the project such as cash or inventory. So for example, when opening a new Nordstrom store, the company needs more cash in the registers and more inventory. So this extra amount is considered part of the project's initial investment. So the last one of the cash outflows is the ongoing cost. These are the future spending on repairs, maintenance, and other operating expenses. Now let's proceed to the cash inflows. So typical cash inflows, most projects have at least three types of cash inflows. So the first one is the higher revenues or lower cost. So if a project helps the company earn more money or spend less, that extra amount is a cash inflow, or it saves money, works the same as earning money. The second one is the salvage value. So when a project ends, the company may sell the equipment used. So the money received from selling the equipment is an example of cash inflow. The last one is the released working capital. So these are the money tied up in inventory or accounts receivable during the project is freed at the end. So getting this money back is another example of cash inflow. So now let us proceed to the time value of money. So beyond defining a capital project's cash outflows and inflows, it is also very important to consider when those cash flows occur. For example, imagine you have $1,000 today. If you put it in the bank, it can earn interest and become more in the future. But if someone gives you that the same amount of $1,000 1 year from now, you lose the chance to earn interest during that year. So its value is less to you today. So this simple example illustrates an important capital budgeting concept known as the time value of money. The time value of money recognizes that a dollar today is worth more than a dollar a year from now, if for no other reason than you could put the dollar in a bank today and have more than a dollar a year from now. So in capital budgeting, the payback method ignores the time value of money. It treats all dollars the same, no matter when they are received. And in the net present value and the internal rate return, or the IRR, it recognizes the time value of money. They use discounting, which converts future cash flows into their present value so they can be compared fairly. So let us now discuss the payback method. So the payback method of evaluating capital budgeting projects focuses on the payback period. The payback period is the length of time that it takes for a project to recover its initial cost from the net cash inflows that it generates. So the company decides that if a shorter the payback period, it is more desirable to invest. So let's have an example. Your company needs a new milling machine. The company is considering two machines, Machine A and Machine B. Machine A costs $15,000. It has a useful life of 10 years and it will reduce the operating cost by $5,000 per year. Machine B only costs $12,000. Will also reduce operating cost by $5,000 per year but has a useful life of only 5 years. So to determine which machine your company should purchase, we need to calculate for its payback time period using the formula. So the formula is payback period equals investment required divided by the annual net cash inflow. So the solution is, let us first calculate the machine A. So machine A is cost $15,000 divided by the annual net cash inflow, which is $5,000, which equals to 3.3 years, So now let's proceed to machine B. So machine B cost $12,000 divided by $5,000. So it will equals to 2.4 years or 2 years and 4 months. So which machine should your company purchase? So based on the solution, machine B should be purchased because it pays for itself faster. It pays period 2.4 years, which is shorter than machine A that has an equivalent of 3 years. So according to the payback method, a project with has a quicker cost recovery is more desirable because the company gets its investment back sooner and it reduces risk. So let us now proceed to the evaluation of the payback method. The payback method determines how quickly an investment's initial cost is recovered. However, it is not true measures of profitability because it ignores cash flows after the payback period and it fails to account for the time value of money, meaning that cash received in the future is treated the same as cash received today. So as you can see in the cash stream inflows, so machine A versus machine B illustrate their time period. For instance, a project with a shorter payback period might not have be better investment if it has a shorter useful life or it has its cash flow arrive much later. So despite these limitations, the payback method can be useful as the preliminary screening tool to quickly assess if an investment is worth considering further. So let us now proceed to the discussion of an extended example of payback. So the payback period measures how long it takes for an investment to generate enough net cash inflow to recover its initial cost. When new equipment replaces old equipment, the salvage value of the old equipment is deducted from the cost of the new equipment so that only the incremental investment is considered. Additionally, depreciation is added back to the net operating income to determine the true cash inflow because depreciation is a non-cash expense. So, for example, the Good Time Fun Centers Incorporation operates amusement parks. Some of the vending machines in one of the parks provide very little revenue, so the company is considering removing the machines and installing equipment to dispense soft ice cream. The equipment would cost $80,000 and have an 8-year useful life with no salvage value. Incremental annual revenues and costs associated with the sale of ice cream would be as follows. As you can see, the sales is 150,000, the variable expenses is 90,000. The sales was deducted from the variable expenses, so the total contribution margin is $60,000. So let's proceed to the fixed expenses. We have the salaries, which is $20,000. The maintenance for the machine is $3,000. The depreciation is $10,000. So the total fixed expenses is $40,000. So contribution margin deducted from the total fixed expenses is equals to $20,000, which is the net operating income. The vending machines can be sold for a $5,000 scrap value. The company will not purchase the equipment unless it has a payback period of 3 years or less. So, does the ice cream dispenser pass this hurdle? So, the answer is, in the Good Time Fun Center's example, the ice cream dispensing equipment cost is $80,000 but replaces the vending machine that can be sold for $5,000, resulting in a net investment of $75,000. The equipment generates annual net operating income of $20,000, but when the depreciation of $10,000 is added back, the annual net cash inflows is equals to $30,000. So the payback period is therefore $75,000 divided by $30,000 is equals to 2.5 years. So because this is less than the required maximum of 3 years, the project meets the company's payback criteria. Let's move on to the payback and uneven cash flows. The payback and uneven cash flows, when the cash flows associated with an investment project change from year to year, the simple payback formula that we outlined earlier cannot be used. Instead, the payback period can be computed as follows. So, we assume that cash inflows occur evenly throughout the year. So the formula is payback period equals to number of years up to the year in which the investment is paid off plus the uncovered investment at the beginning of the year in which the investment is paid off divided by the cash inflow in the period in which the investment is paid off. So to illustrate how to apply this formula, let us consider the following data. So based on the given data, so what is the payback period on the investment? So the answer is 5.5 years, computed as follow. 5 plus 1,500 divided by the $3,000 is equals to 5.5 years. So in essence, we are tracking the uncovered investment year by year as shown in the exhibit 13-2, by the middle of the sixth year, sufficient cash inflows have been realized to cover the entire investment of $60,000 multiplied by $4,000 plus $2,000. So that's all for my part.
Once again, good day everyone. My name is Jean H. Macaroy, and I'll be discussing the continuation of our report, the net present value method. So, net present value compares the present value of a project's cash inflows to its cash outflows. The difference between them, called net present value, helps decide if a project is a good investment or not. So, net present value or NPV methods help us see if an investment is worth it. We compare the money we expect to receive in the future with the money we need to spend today. So if the value of the inflows is higher than the outflows, the investment is usually good. NPV or net present value gives us a clear number that shows whether the project will benefit the company or not. So next, when performing net present value analysis, managers usually make two important assumptions. So first, cash inflows happened at the end of each period. So this means that we assume that all cash coming in arrives at the end of each period. So even if in real life it arrives at different times, this just makes the math easier. So next, the second one, all cash flows are reinvested at the same rate used to discount them. So this means that we assume that any money earned from the project is reinvested at the same discount rate we used in the computation. So if these assumptions aren't followed in real life, the NPV or the net present value result might not be completely accurate, but it still gives managers a reliable estimate. So next, to illustrate the net present analysis, consider the following data. So here we have an example. So in this example, Harper Company wants to know if buying a $50,000 machine is worth it. The machine will save them $18,000 every year for 5 years, and they can still sell it later for $5,000. But before deciding, they must check if this investment meets the requirement of earning at least 18% return. So even if the total savings look big, $90,000 over 5 years, that's not enough to immediately say yes. So the company needs to be sure that the project earns at least 18% return. Because if they can earn that much somewhere else, they should only buy the machine if it performs just as well or better. So to decide the $18,000 yearly savings and the $5,000 salvage value must be discounted to their present values and compared to the machine cost. So this means in order to make the right choice, they must convert all future savings and the machine's final value into today's value. This is what discounting means. After getting the present values, they compare everything to the cost of the machine to see if it is financially worthwhile. So as you can see in the picture, Exhibit 13-3, the calculates NPV or net present value by discounting the initial cost, the yearly savings using an annuity factor, and the salvage value using a single sum factor. So the result is an NPV or net present value of $8,471. So it discounts the $50,000 cost, then discounts all the yearly savings using a single annuity factor, and discounts the $5,000 salvage value. When all these are added, and NPV or net present value comes out to $8,471. So next, in Exhibit 13-4, discounts each year separately instead of using an annuity factor. This method also gives an NPV or net present value of $8,471. So in this method, instead of using an annuity factor, each year's cash savings are discounted individually. Using different discount factors, the salvage value is also discounted. Even though it's done differently, it still result in the same NPV, which is $8,471. So as you can see, both Exhibit 13-3 and Exhibit 13-4 give the same NPV because the methods are mathematically equivalent. So next, as you can see in Exhibit 13-5, this part tells us that we can use exact discount factors or even Excel to compute NPV. When Excel uses unrounded numbers, the answer becomes a little higher, which is $8,475. But the difference is very small and doesn't affect the decision. So as you can see in the picture, if the NPV or net present value is positive, the project earns more than the required rate. So it's a good choice. If it's zero, it's just enough to meet the required return. But if it's negative, then the project doesn't earn enough and should be rejected. So, sa niaging example, which is the Harper Company, has positive net price value, which is $8,471, rounded factors, or the $8,475, which is using the exact Excel factors. So both results are positive, which means the machine should be purchased because the project more than the required 18% rate of return. A company's cost of capital is the minimum return it must earn to pay creditors and shareholders. Any project earning less than this should be rejected. So this means that the cost of capital is like the company's minimum acceptable return. If a project earns less than this, it won't generate enough to pay the people who invested money in the business. So when using cost of capital as the discount rate, any project with a negative net present value doesn't cover the cost of capital and should be rejected. So if the discount rate used is the cost of capital, then a negative net present value means the project cannot even cover the cost. So the company should not accept the project. Next, recovery of the original investment. So a positive NPV or net present value means the project not only recovers the original investment but also earns enough extra cash to compensate the company for using its money in the project. So this means that the NPV method already includes the recovery of the initial investment. So if the NPV or net present value is positive, the project doesn't just return the money we spent, it also gives us more than enough to make up for using our funds. So to demonstrate this point, consider the following situation. So we have here an example. So in this example, Carver Hospital wants to buy an X-ray attachment for $3,170. It won't have any value after 4 years, but it will help earn $1,000 each year. The hospital requires at least a 10% return, so they must check if this investment meets that. So, as you can see in the picture, Exhibit 13-6, using the 10% discount factor of 3.170, the NPV of the project is 0, meaning the investment earns exactly 10%. So when they compute the NPV using the 10% discount factor, the result is exactly 0. That means the project earns exactly the required 10% return, not more, not less. Next, in Exhibit 13-7 shows the breakdown of each year's $1,000 cash inflow between recovery of investment and return on investment. So each annual $1,000 inflow consists of two parts. So part of the original investment being recorded and the return earned on the remaining investment. So this explains that the $1,000 earned each year is not pure profit. Part of that money is simply giving back some of the original investment, and the rest is the actual return or earnings from the investment. So in the first year, the $1,000 includes $317 of actual earnings. That's the 10% return. And the remaining $683 helps pay back the initial cost. Each year, the amount left to cover becomes smaller. So the return portion also gets smaller. By the end of the fourth year, the entire $3,170 is fully recovered. So next, we have an extended example of the net present value method. So the example below gives a more detailed situation to show how the net present value works in evaluating a project. So based on the example, the Swinyard Corporation has a chance to market a new product for 5 years. To do this, they need equipment, working capital, and a future overhaul. They also estimate their sales and yearly cost as they can calculate whether the project is profitable. If Swinyard doesn't renew the license after 5 years, the working capital is returned. The company uses a 14% discount rate to judge the project. So at the end of 5 years, if they stop the project, they get their working capital back. And since their required rate of return is 14%, the NPV calculations must prove that the project can meet or exceed that rate. The example includes several types of cash inflows and outflows. The full NPV solution is shown in Exhibit 13-8. So as you can see in the picture, notice how the working capital is handled in this exhibit. It is counted as a cash outflow at the beginning of the project, which is the cell letter B4, and as a cash inflow when it is released at the end of the project, which is the found in the cell G10. Also noticed how the sales revenues, cost of goods sold, and out-of-pocket costs are handled. Out-of-pocket costs are actual cash outlays for salaries, advertising, and other operating expenses. So these are expenses that require the company to spend real money. No estimates, not non-cash charges, but actual cash going out. So because of NPV is positive, the new product is acceptable. So the final result shows a positive net present value or NPV, which is $31,410. This means the project earns more than the required 14% return. So it is financially a good decision and the product should be introduced. So next, we have the internal rate of return method. So the internal rate of return or IRR is the rate of return a project earns over its life. It is the discount rate that makes the present value of inflows equal to the present value of outflows, or NPV is equals to 0. So in this part, the internal rate of return or IRR is the exact percentage return a project earns. So it is the discount rate that makes the project break even in present value terms, meaning the inflows and outflows match perfectly. When that happens, the net present value becomes 0. So we have here an example. So based on the example, the school district wants to replace their small mower with a tractor mower. It costs $16,950 and will save them $3,000 every year in labor for 10 years. There's no salvage value, so we can ignore that. So as you can see in the picture, we have here the formula. To find internal rate of return with equal yearly inflows, divide the investment by the annual net cash inflow. The result is a factor used to look up the IRR in a table. So, using the formula, when we divide the cost by the manual savings, we get 5,650. This factor tells us what rate of return would turn 10 years of $3,000 inflows into a present value equals to $16,950. So as you can see in the picture, Exhibit 13-9, using the 10-year line table, a factor of 5,650 corresponds to a 12% return. So the IRR is 12%. So when we go to the 10-period row, as you can see there in the table, and look for 5,650, we see that the closest percentage is 12%. This means the project earns a 12% internal rate of return. Using a 12% discount rate makes the NPV equal to 0, confirming that 12% is the IRR. So if we calculate the NPV using a 12% discount rate, the inflows and outflows balance perfectly. This results in an NPV of 0, which proves that 12% is the correct IRR. A project is accepted if IRR is greater than or equal to required rate of return, and rejected if IRR is less than required rate. If Glendale requires 15%, they would reject this 12% project. So this means that the school district must compare the IRR to what they require. If their minimum acceptable is 15%, the project fails because it only earns 12%. That means it should be rejected. This rule applies to any investment. If IRR meets or beats the required rate, accept it. If it doesn't, then reject it. Now let's move on to the comparison of the net present value and internal rate of return methods. So both NPV and IRR use the cost of capital to screen projects. IRR compares the project return to the hurdle rate, while the NPV uses the cost of capital as the discount rate and rejects project with negative NPV. So this means that both NPV and IRR help us decide whether a project is worth accepting by using the company's cost of capital. So for IRR, we check if the project's return is higher than the hurdle rate. If it's not, we reject it. For NPV, we use the cost of capital as the discount rate. And if the NPV turns out negative, we also reject the project. So basically, both methods use the same idea, comparing the project to the company's minimum acceptable return. Next, Present value is often easier to use than IRR, especially when cash flows differ each year. IRR may require trial and error or software, while NPV is more straightforward in spreadsheets. So this explains that NPV is usually simpler to use, especially when cash flows are not the same every year. IRR can get a bit complicated because you might need trial and error to find the exact rate that makes NPV zero. You can use a computer to do it fast, but NPV still tends to be the easier and clearer method when doing calculations. So, next, the IRR method makes a more unrealistic assumption. It assumes cash inflows are reinvested at the project's own IRR. NPV assumes reinvestment at the discount rate, which is usually more realistic. When NPV and IRR disagree, NPV is preferred. So this part talks about a big difference between the two methods. IRR assumes that the money earned from the project can be reinvested at the same high rate of return as the project itself, which is often not realistic. NPV, on the other hand, assumes reinvestment at the discount rate, usually the company's cost of capital, which makes more sense in real life. So if ever NPV and IRR they give different recommendations, it's safer to trust NPV because it uses a more realistic assumption. So next, expanding the net present value method. The total cost approach is the most flexible method for comparing competing projects. To illustrate the mechanics of the approach, consider the following data. So, based on the example, the company is deciding what to do with a ferry that's in the bad shape. Renovating the old ferry requires spending $200,000 now and another $80,000 later. The ferry will last 5 years, bring in $400,000 per year, and cost $300,000 per year to operate. At the end, they can sell it for $60,000. So, alternatively, they can buy a new ferry for $360,000 with $30,000 repairs in year 3, 5-year life, $210,000 annual operating cost, $400,000 revenue, and $60,000 salvage. So this means the other option is to buy a brand new ferry. It costs more upfront, which is $360,000, but is cheaper to operate at $210,000 per year. It also lasts 5 years, requires minor repairs in year 3, and can be sold for $60,000 at the end. Revenue remains $400,000 per year. Harper Ferry Company requires a 14% return on investment. NPV is used to compare the two alternatives. So this means that the company wants at least 14% return on any project. So using the total cost approach, we calculate the net present value or NPV for both the old ferry renovation and the new ferry purchase to see which option makes more financial sense. The total cost approach includes all cash inflows and outflows for each alternative without separating relevant from irrelevant cash flows. So this means that one of the strengths of the total cost approach is that it considers everything, every dollar in and out, rather than trying to pick only certain relevant cash flows. This makes it easier and more complete compare projects. As you can see in the picture, Exhibit 13-10, after computing the NPV or net present value for each choice, you can directly see which option is better. You can even compare more than two options if you want. So in this example, buying the new ferry gives an NPV of $252,630, which clearly shows it's the better financial decision compared to renovating the old ferry. So let's go to least cost decisions. Some decisions involve no revenue. The best choice is the one with the lowest total cost in present value terms. These are called least cost decisions. So this means that sometimes a company doesn't make money directly from a decision. Like for example, deciding whether to buy or lease a jet. In these cases, the goal is simply to spend the least amount of money overall. The alternative with the lowest total cost, considering the time value of money, is the best choice. So, to illustrate a least cost decision, consider the following data. So, here we have an example. So, in this example, Valtech wants to replace an old threading machine. The new machine costs more upfront, but it saves money every year in operating cost. The data shows purchase prices, salvage values, operating cost, and overhauls for both machines, which we use to make a total cost comparison. So as you can see in the picture, the company uses a 10% discount rate to account for the time value of money. The company uses a 10% discount rate to account for the time value of money. By calculating the present value of all costs for both machines, we can see which option is cheaper, even though both options have negative present values because there's no revenue. The new machine cost $109,500 less overall, so it's the better choice. Now let's move on to the uncertain cash flows. So here's an example. Investments in automated equipment have tangible benefits like cost savings and intangible benefits like reliability and speed, which are harder to estimate. So, take automated equipment as an example. We can easily estimate upfront cost and obvious benefits like lower operating costs. But intangible benefits like production, higher quality, and better reliability are harder to put a dollar value on. So these can still impact cash flows, but estimating them is tricky. So here's a simple technique. Calculate the extra cash flow needed from intangible benefits to make a project with negative NPV financially attractive. So this means that one easy way to handle uncertainty is to figure out how much additional cash flow from intangible benefits would make the project worthwhile. So, for example, if a project has a negative net present value of $226,000 and a present value factor of 5.65, dividing $226,000 by 5.65 tells us that the intangible benefits need to be at least $40,000 per year to make the project worth it. If intangible benefits are estimated to be worth at least the required extra cash flow, the project should be accepted. Otherwise, it should be rejected. So, if management thinks the intangible benefits really provide at least $40,000 per year, the project should go ahead. But if they believe it's less than that, it's better to reject the project. This method helps make decisions even when future cash flows aren't perfectly known. So this technique can also be applied when other cash flows like salvage values are uncertain. So the same idea works if other parts of the cash flow are hard to estimate, like salvage value. For example, if a supertanker project has all cash flows known except for the value of the ship in 20 years, we can calculate what salvage value is needed to make the project worthwhile. So we have here an example. In this example, the project's NPV or net present value is negative $1.04 million without considering the salvage value. So using the present value factor for 20 years, dividing $1.04 million by 0.104 shows that the salvage value must be at least $10 million for the investment to make sense. So if the management thinks the salvage value will be lower, the project shouldn't be done. This approach allows manager to make informed decisions under uncertainty by determining the minimum value of uncertain cash flows needed for a positive net present value. So, this technique helps managers handle uncertainty by calculating the minimum cash flows required from intangible benefits or salvage values. It gives a clear number to guide decisions even when future outcomes are not certain. Next, preference decisions, the ranking of investment projects. So after screening, managers make preference decisions to rank acceptable investment proposal to determine which to pursue first. So once a company has decided which projects are acceptable through screening, the next step is to rank them. Preference decisions help answer the question, which of these good projects should we invest in first? It's like making a to-do list for the best investments. Preference decisions are also called rationing or king decisions because limited funds must be allocated among competing alternatives. So sometimes these are called rationing decisions because the company doesn't have unlimited money. We need to choose the best projects and decide how to allocate funds wisely among them. Both NPV and IRR methods can be used to rank projects, but if they conflict, NPV is more reliable. So this means to rank projects, manager can use either net present value or internal rate of return. However, if the two methods give different rankings, it's better to rely on NPV or net present value because it makes more realistic assumptions about returns and cash flows. Internal rate of return method. So when using the IRR method to rank investments, the basic rule is simple. The higher the IRR, the better the project. So for example, a project with an 18% return is usually preferred over one with a 15% return. So IRR is a popular way to rank competing projects because it shows the percentage return expected from each project. So next, net present value method. So NPV alone cannot compare projects with different initial investments. The project profitability index or PPI can be used. The higher the PPI, the more desirable the project. So this means unlike the IRR, NPV can't always be compared directly if the project require different amounts of money. So let's say for example, if investment A requires $10,000 and investment B requires $5,000, comparing NPVs alone can be misleading. So instead, we use the project profitability index or PPI, which is basically NPV divided by the initial investment. This shows which project gives the most return per dollar invested. So in our example, investment B has the higher PPI and is the better choice. So here's the picture of the formula. So the PPI accounts for initial cash outflows, salvage value, and working capital needs, helping rank projects when funds are limited. So this means that the PPI is very useful. when money is limited because it tells us how much return we get per dollar invested. The investment required in the formula includes all cash spent at the start, minus any salvage value from old equipment, and any working capital the project needs. Essentially, it helps managers allocate limited funds to the projects that gives the best financial return. So that's all for my report. The continuation of this will be explained by the next reporter. Thank you.